Welcome to Satya Skills. In this video, let us learn the history of insurance regulations in India with special reference to Insurance Act of 1938. During British rule, the Indian insurance companies were governed by the Companies Act 1881. During 1900 to 1915, the government, the experts in the insurance and finance sectors expressed that Companies Act was inadequate to regulate insurance companies. The insurance business depends on the trust of general public that it is able to gain during its business. Public trust will be more if the business is well regulated either by the government or by the powerful authority with a strong legal backing. With this idea, the British Indian government passed two acts to regulate insurance business in 1912. They were Provident Insurance Societies Act 1912 and Indian Life Insurance Act 1912. These two acts were based on English Insurance Act. But these two acts were confined to only life insurance business and non-life business was left. Therefore, there was another need for another act. There were several gaps and defects in these two acts. According to these two acts, the rules and regulations to control insurance business were not very strict, and also they left several areas. Example, there were no restrictions on investment. Any person can start it easily. This resulted in growth of inefficient and financially weak companies. The Act failed to check unhealthy organizations. Above these, there was no act to regulate general insurance. Though there were marine and fire insurance companies in those days, there were no regulations to control general insurance companies. To rectify the defects, some amendments were made to the existing these two acts, but all the attempts were of less use because the needs are many. Experts demanded for a separate act. The Government of India understood the need to introduce a new insurance act which can fill up the gaps and satisfy the demand. For this purpose, the government appointed a committee in 1935. The committee submitted its reports with several changes and recommendations. Accepting the recommendations, the government introduced a bill in the parliament in 1937 and the Insurance Act 1938 was passed. Insurance Act 1938 was the first comprehensive policy which was designed to regulate both life and non-life insurance sectors. Its scope was very wide. The Act was more powerful to regulate all types of insurance business. The Act was able to check unhealthy expansion of insurance companies. Now, let us look into the features. The Act applies to all types of insurance business including fire, marine, life and other general insurance. It also governs companies, mutual offices and cooperative societies. Then, capital. Prior to the passing of the Act, any person can start insurance business with 25,000 capital. The Act 1938 insisted that it should be 50,000 rupees excluding deposits to be made before registration. Deposits. All insurance companies shall make a substantial amount of deposit with the Reserve Bank of India. The insurer has to deposit specified amount with RBI either in the form of cash or in approved securities. Then again there is one more thing, that is for each category of business the Act gave different amounts to be deposited with the central bank, that is RBI. Now, registration. The provision of the Act with regard to registration specifies that the insurance business established before passing the Act should get certificate of registration from the Office of Controller of Insurance within 3 months of the commencement of the Act. No new business, no new insurer shall start business without obtaining certificate of registration from the Controller of Insurance. The insurer who was carrying on any type of insurance business in India at the commencement of the Act, if fails to obtain certificate of registration, shall not operate business. All contracts entered by him were invalid. The insurer should apply to the Controller of Insurance for registration along with the company documents, details of nature of business. After scrutinizing the application, certificate of registration shall be issued to the insurer. If the insurer fails to observe Especially if he forgets or overlooks 7th and 8th sections, controller can cancel the registration. Now, the Act provides that the insurer shall submit the following documents to the controller. They are audited accounts, balance sheet and abstract of the report. All these are signed by the chairman and 2 directors. Insurer shall provide statements showing total assets and liabilities of the insurance company. Then with regard to commission agents, the Act imposed several restrictions on the payment of commission to agents and granting license to agents. The Act prescribed the qualifications to be observed by the insurer to grant license. License issued under the Act shall entitle the holder of the insurance to act as an insurance agent for any insurer, any insurance company. Then the Act laid down that 55% of net liabilities of Indian or British insurer should be invested in Indian government and approved securities. This provision checks the diversion of assets to unsafe investments. Prohibition of loan. No insurer shall grant loans otherwise except loans or life policies issued by him to any director, manager, managing agents, etc. Investigation. The government may at any time direct the controller of controller of insurance to investigate the affairs of any insurer and report to the government on any investigation made by him. The Act specified the duties and powers of the controller of insurance. That's all.